Hello, and welcome to the latest episode of Wealth Management Invest. I am your host, David Bodamer. I'm an editorial director with wealthmanagement.com. I oversee our investments coverage as well as some other editorial operations. And on today's episode, we have with us Don Calcagni, who is the Chief Investment Officer for Mercer. Don, welcome to the podcast.
Great, David. It's great to be here.
So, before we get into it, if you just want to, it entails in terms of being chief investment officer and anything you want to say about Mercer.
Yeah, as Chief Investment Officer at Mercer Advisors, I oversee the investment team, which, at Mercer Advisors consists of over 100 full-time employees, and collectively we're responsible for the prudent stewardship of nearly $80 billion of clients' life savings. So it's an enormous responsibility. It's an outstanding career. It's been a great ride watching the organization grow over the past 20 plus years that I've been here at the organization.
So, what is your overall guidance in terms of just, how you're trying to position like the overall portfolio at this point?
Well, David, I think it goes back to doing, there's certain things you have to get right from the outset. And the first thing that all investors have to really understand is, what are they investing for? Like, what's the
Mhm.
objective for their portfolio? They need to understand how it interacts with their broader balance sheet, their tax situation, and then they need to understand why the asset allocation in their portfolio looks the way that it does. Why do they have a certain amount in stocks? Why do they have a certain amount in bonds or real estate or private equity? Understanding the why behind the what, I think, is probably the most important order of business to get right. And I would argue it's probably by far the most common error that we see among unsuccessful investors, is that they forget why they're investing, why they're invested the way that they are. And I think if you do that, then the second order of business, David, is to make sure that the portfolio is appropriately, and I underscore that word, appropriately diversified across and within major asset classes. Far too often, investors are woefully under diversified, and I would argue that diversification is poorly understood and often suffers from user error. Even though you hear financial advisors talk about diversification all the time, I can't tell you how often we see portfolios that really do suffer from a lack of diversification. So that would be the second order of business, David, is making sure you get that. If you get those two things right, most of us are going to be just fine.
Just to kind of reiterate, the important is to start with the goals, talking with the understanding of what the client's goals are, understanding what their positions are, and then using that as your starting point for like thinking out what the maybe get what their specific allocations might need to be.
Absolutely. And I think related to that, David, is making sure that you understand that your investment portfolio is just one part of your balance sheet.
Hmm.
Too often we look at our investment accounts, our IRAs, 401ks, or our taxable accounts or a trust account in isolation. And that is a major mistake. The IRS certainly does not look at your investment portfolio in isolation. They look at your entire net worth and ultimately determine what your tax bill is going to be every year. So looking at that portfolio through the lens of your broader balance sheet, I think, is part of that first order of business.
And then, so when you talk about diversification, can you drill into that a little bit more? Like not just, I'm thinking you're not just talking about maybe like 60/40, like broad buckets, but actually getting a little bit more granular than that, and even maybe thinking outside of the traditional equities and bonds.
Yeah, absolutely. I mean, David, when you think of the 60/40 portfolio, I can't tell you how many versions of the 60/40 portfolio that I've seen in my career. The simplest version is 60% S&P 500 index and 40% US Barclays aggregate fixed,
Hmm.
bond index, right? That portfolio by itself suffers from not just a lack of diversification globally, but even within the US stock market, right? The S&P 500 index is not the entire US stock market. There
Right.
are mid cap stocks, there's small cap stocks, and so on and so forth. And likewise for the Barclays US aggregate index, right? That's just a US bond index, which at this particular point in time is very overweight US Treasuries, just
Hmm.
given the amount of issuance that we've seen in the market over the past several decades. And so, just looking at that very simple, very common sort of representation of what constitutes a 60/40, that portfolio suffers from a massive lack of diversification. And so, certainly owning broadly diversified ETFs and things like that, that's a great starting point. But you need to make sure that you own lots of different asset classes in the portfolio. Look at market performance year to date this year. The Mag 7, these were the big tech stock winners of the past couple of years. They're down 15% as of this morning. And yet, non US equities, which have been unloved for the better
Right.
part of a decade, are massively outperforming US stocks by massive margins. And so, owning those non US stocks, owning small cap stocks, moving beyond just a simple bond ETF or the Barclays index, those are the things that investors need to be doing just within public markets, but they should also be looking beyond public markets, looking into things like private equity, private credit, private infrastructure, to take part of that portfolio and allocate it to less liquid markets that offer much higher return prospects, which could really help drive their portfolio and help diversify their portfolio during times like now when market volatility has reared its ugly head.
Yeah, so there's a lot there that to kind of unpack. On one hand, I could see there being a situation where, maybe if you had a balanced portfolio, but just because of the performance of large caps, maybe you ended up even more unbalanced there. So that you maybe have to reallocate. Do you have to go back and reallocate to actually get the exposures right to look back at some of these other, international small caps just on the equities piece?
Yeah, you absolutely do. I mean, what you're raising is an important point, and that's for most investors, we invest in what we call a long only portfolio. So, by
Hmm.
definition, if we're going to diversify into non-US equities or to small cap stocks, yeah, it means we need to sell some of the large cap stocks in the portfolio and move that capital elsewhere. So, that by definition means that we are now going to dial down the allocation, frankly, to these very popular big winners of the past decade.
Hmm.
And I think that raises another important point, and that is that, we often say at Mercer that the biggest risk in any investment portfolio isn't any of the investments, it's the investor, right? And managing the investor's mindset. And so selling out of those high flying big winners of the past decade to allocate, frankly, to asset classes that have been unloved, that have not performed as well as Nvidia or Tesla or Amazon,
Hmm.
but doing so with an eye towards risk management. And so, yes, that does require, if you're going to allocate and diversify appropriately, it means that you're going to move beyond the big winners of yesteryear.
And yeah, I'd imagine, dealing with investors, obviously, people can react, overreact one way or the other. So part of the job is probably got to be like, re keeping people from making like panic moves or like talking them constantly into like having more long-term visions around their portfolios.
I mean, absolutely. I mean, if you just look at the data, it is really eye-opening to see how much self-directed do-it-yourself investors woefully underperform just something as simple as the S&P 500 index. And a lot of research, a lot of academic research has shown that that is purely because of behavioral reasons. They're not well diversified. They tend to time markets. They tend to buy at the worst times and they tend to sell at the worst times. So, what do you do with that information? Well, the takeaway from those studies, David, is that we need to control our emotions, right? We need to manage investor behavior probably more so than we need to manage investment risk. Not saying that investment risk is not critically important to manage, but I would argue at least equally so would be managing our emotions.
And, when you do have to make some of these rebalancing, are you managing, are a lot of clients in SMAs or UMAs where there's also you're taking advantage of like tax loss harvesting or things like that as you're making these kind of portfolio tweaks?
So at Mercer Advisors, we certainly do. We are what we call a vehicle agnostic organization when it
Hmm.
comes to portfolio implementation. So when we design a custom portfolio for a client, we can implement that portfolio using any combination of individual securities, mutual funds, ETFs, perhaps even some of the legacy securities that clients have brought into the organization. And so within those portfolios, we certainly do engage in daily tax loss harvesting. So as tax loss opportunities present themselves, our trading team is rebalancing the portfolio, harvesting those tax losses. Like I said earlier, it's important to look at your portfolio as part of your broader balance sheet. And so, for example, harvesting those tax losses on a daily basis really helps our clients and our advisors to maximize the total value of clients' entire balance sheets and not just a specific investment portfolio.
And my understanding is that some of the stuff has become more accessible, like where in the past, SMA, you may used to have a higher, will only be available to like investors of a certain size. Now this is can be applied to a broader class of investors. Is that accurate?
That is accurate. I mean, technology continues to revolutionize and democratize, I would argue, financial markets. And so things
Hmm.
like separately managed account strategies that perhaps invest in, the S&P 500 index, but instead of owning an ETF, they own all the stocks of the S&P or a representative basket of stocks in the S&P. In the old days, it would be nothing for an SMA like that to have a $10 million minimum.
Hmm.
Nowadays, you can invest in that type of strategy, oftentimes for as little as 50 or $60,000. So you're right that technology has really brought a lot of these solutions to a place where they're now more accessible by a wider set of investors. I think there's still a lot of investor education that needs to go along with those types of solutions because they do function and operate materially different than perhaps what some investors are accustomed to. For example, trading ETFs in an
Hmm.
online account, investing in a third party separately managed account strategy is a very different solution that still requires a fair amount of investor education.
Yeah, I can imagine it might get overwhelming. Like if you inherently are moving from an ETF to an SMA, that's even the same strategy. At least the ETF, it's like one ticker, one set of things versus seeing an SMA that's got suddenly hundreds of securities that you're in. So I imagine that's part of the process of like of the education.
Absolutely, David. It goes back to my first point, which is understanding the why behind the what.
Hmm.
An S&P 500 index ETF and an S&P 500 SMA replication portfolio, in theory, are the same exact thing, right? They offer you broad exposure to the S&P 500 index. However, you would invest in those two different vehicle constructs for very different reasons. Owning the ETF is very inexpensive. It's very easy. It's deeply liquid. You can point and click, and you can trade it all day long if that was your heart's desire. Owning an SMA that owns, let's just say, 500 stocks in theory, typically investors would own that, one, because they want to see the companies in the portfolio, right? There are many investors, David, that don't like seeing the wrapper. They want to see
Hmm.
Tesla, they want to see Coca-Cola, they want to see those companies in the portfolio. But number two, I think one of the best economic reasons for owning an SMA is when you own all 500 stocks in the market, you can now engage in very surgical tax management. So, for example, you can take your high flyers out of the portfolio, you can gift them to charity, you can now tax loss harvest all the way down to the individual stock level. Whereas with an ETF, you own the entire ETF. So while 100 stocks in the market may be at a loss, if the ETF is still slightly at a gain because it's a market cap weighted
Hmm.
ETF, you don't have those tax loss harvesting opportunities. So, generally speaking, larger investors, taxable investors with larger balance sheets typically prefer owning the SMA because of all the tax benefits that doing so affords them.
And do you have to allow for fractional ownership of stocks in order to be able to do that, or is it you don't have to do that?
You don't have to do that. Some providers do. You raise an important point. As we lower the minimums
Hmm.
for these types of strategies, having some sort of fractional ownership vehicle, and you've seen Schwab come out with these. There's other custodial platforms that have come out with these fractional ownership units. But as you lower the minimums, in order to get an appropriate amount of diversification in the strategy, you need to find some way to complete the portfolio. Some providers will use an ETF to round it out. Other providers are using, these little slices or fractional ownerships of S&P 500 stocks to try to round it out. I think you can still statistically get a pretty good replication of the S&P 500 index for with an SMA with about $100,000 minimum. You can still
Hmm.
own probably 100 stocks, and statistically speaking, that 100 stocks is going to give you almost all of what the movement in the S&P statistically is going to be in any given year. So you'll give up some of the tax benefits because you won't have all 500 stocks, but with 100 stocks or 150 stocks, you're getting pretty darn close to capturing
Right.
most of the benefits.
You could still do quite a bit of the tax loss harvesting and all these other things that you're talking about because that's still a pretty good chunk of companies you've got.
Correct, correct.
So pivoting to like another theme, something hearing a lot about right now is just active versus passive, and where what strategies may be more attractive for active, or if they're area. There's obviously a massive proliferation of active ETF launches these days. Do you have any thoughts on like active management versus passive?
We certainly do. It's amazing. I've been in this profession now for 30 years, and every time we have this discussion, I'm still surprised that we're having the active passive conversation because traditional active investing has been largely discredited over the past 30 to 40 years. So what do I mean by that? I think we need to be more precise
Hmm.
when we talk about active management.
Yeah.
Within the realm of active management, there's two broad types. There's full discretionary active management, which I would call non-systematic, non-rules based active management. That's where
Hmm.
you're hiring the hero, the
Right.
guru, to try to pick stocks. That is a very discredited approach to portfolio management. And so we don't believe that there's any place really in the portfolio for that. The second type of active management is rules-based or systematically active approaches to managing portfolios. And that's really where the academic and professional literature has landed in terms of being, quote, the best way to construct portfolios. So these are portfolios that systematically, in a rules-based way, overweight things like value stocks, high
Mm.
profitability stocks, perhaps momentum stocks, things like that, where we're trying to remove human discretion from the equation. Remember, it's that human discretion, by the way, that results in very dramatic underperformance by DIY investors. Well, the dirty little secret is that professional investors are still human. We all
Right.
suffer
Right.
from the same biases as do-it-yourself investors, and so bringing a rules-based approach to the portfolio, in our view, makes a lot of sense. It's fully aligned with the science, the financial science these days with respect to portfolio management. Now, there's still an important role to play for passive, so I don't want to ignore passive. We still think there's an important role to play for having that, sort of Vanguard-esque core beta approach, and taking a core satellite approach to
Hmm.
portfolio construction. That helps you push down fees. It helps you make sure that you are capturing most of the market's movement. But then with your satellite positions, you can make that bet on deep value stocks or high dividend stocks or highly profitable stocks or momentum stocks in the portfolio. So that's how we think about this, quote, active versus passive debate.
I think that's very interesting and important, and I do think it is probably worth having a bigger discussion in the industry about how we're even using those terms, because like we are lumping in what are as two very different concepts and calling them the same thing, and when they have very actually different outcomes as you're talking about. So that's something
Yep.
actually I've been hearing a little more too, and I feel like I should be more mindful of it even when I'm talking about it at this point. I mean, I've also heard too, like like there are certain like, well, obviously like much harder to. I think Morningstar's does a lot of, they do a lot of analysis, and found where active it can outperform and not, and like, and I think, identifying like fixed income active outcomes have been a little bit better than like say large cap, where it's almost impossible to kind of just outperform the passive counterparts, or not impossible, but it's been in the recent years, it's just not happened.
Yeah, those are claims. I don't know
Mhm.
that those are conclusions.
Okay.
And I'm familiar with the Morningstar work, but I'm also familiar with the SPIVA report that comes out every 6 months from Dow S&P. And I often hear these claims that, quote, active, and again, I think we need to be more precise, what
Right.
kind of active are we talking about? But I hear that active is better, or could outperform potentially in fixed income or in small capitalization stocks or
Hmm.
emerging markets. Candidly, though, when we look at the data that we get from Dow S&P, we don't really see that. We really don't see that. And if there is any outperformance, it is so small that trying to disentangle skill from luck is really a fool's errand, right? It's so marginal. And so I would just be careful. That would be my message to advisors, to investors is, be careful. I love my friends at Morningstar. I love the research they do for the industry, but I would be very careful not to confuse claims with conclusions. I don't think that that is a conclusive argument, in my opinion.
Interesting. And then I guess also the other piece of that is the fees, right? Because
Correct.
when you factor that in, and you may be paying more for the active management, that makes it even harder to potentially deliver the outcomes you would need to justify what you're paying
Yeah.
for it.
Fees and taxes. Now,
Hmm.
nowadays we have active ETFs, which has been all the rage here the past 5 years. But there was a time, David, where I know you and I can remember where mutual funds would kick out those year-end distributions, and you get those 1099s. And so, sure,
Hmm.
so there's also the higher fees that go with active management, but more often than not, actively managed strategies also have much higher turnover. So investors should be mindful of really the only returns that matter are the ones we get to keep. So
Right.
you want to make sure that you're considering the tax implications as well.
So to pivot again to another theme, and you alluded to it earlier, um, private markets, and that's obviously another big trend, and we're seeing a ton of innovation from the the tech platforms, the marketplaces, are constantly adding functionality, trying to make the management and reporting of these things more, the trading them faster. Also seeing a lot of innovation among the asset managers themselves, and the kind of products they're bringing to the market, like private market SMAs. I mean, now we have the private credit ETF, that the State Street one.
Right.
Um, Interval funds, these evergreen vehicles, which I pretty much get, I think, a new one in my press release at least once a week of a new evergreen fund either being put into the pipeline or going effective. So there's just a lot happening in this space. So what is your overall, how are you navigating all of that?
Very cautiously. So I'm always nervous when I see significant innovation in asset classes that historically have not been very accessible to most investors. And so, in some ways, I'm excited to see that, David. It's great to see the democratization, and it's great to see these markets become more accessible to more investors. However, it has become such a field day
Yeah.
among product manufacturers that always gives me a lot of pause. And so, I think that some of these vehicles are very interesting. I like the interval fund structure and concept. I think it brings some 40 Act transparency to those vehicles, but in limited liquidity or semi-liquid format.
Hmm.
So it's exciting to see these innovations. My advice to other RIAs, my advice to investors is proceed with extreme caution. There's a lot of new nomenclature, different investment metrics, different valuation methodologies that these different providers use that can be very arcane, very dense,
Hmm.
and very inaccessible to folks who are not well trained in some of these more highly specialized areas.
So can you talk like also on a global sense, what, what kind of process you have for choosing allocations and doing due diligence on managers and funds? It's like, what does that look like?
So there's a lot there we can unpack it.
Yeah.
I think the first thing to do is unpack the asset allocation decision, right? How do we design asset allocations? And then the second part of it is, okay, how do we implement those? How do we select which managers to use when implementing a portfolio? An asset allocation is really first and foremost a function of the client's balance sheets. And so when we're building custom portfolios for clients, for example, if we're working with a seasoned real estate investor, naturally we're not going to include an allocation to publicly traded REITs or
Right.
private real estate in that particular asset allocation. So we always build a custom asset allocation for clients that really integrates with their broader balance sheet. Now, putting that aside, the way we like to think about the asset allocation exercise is we always want to begin with a broad market weighted approach. That's really the departure point, right? Because at that point, you now have a decision to make. Do you want to depart from the market? Do you want to only invest in US stocks? How much non-US do you want to own if you're on board with that? How much fixed income? How much private markets versus public markets? Those are a function of the client's need, capacity, and tolerance for investment risk. It's also a function of their need for liquidity. Naturally, public markets are deeply liquid, private markets, not so much. And so you have to take into account liquidity, risk tolerance, the risk capacity of their balance sheet, but then also how much risk do they need to assume in order to earn the expected returns that they need for themselves and their family. So the asset allocation is a function of all
Hmm.
of that. In terms of manager selection, in public markets, we are using a whole framework that looks at things like style drift, peer comparisons. We also do a lot of multiple regression to really look under the hood to understand exactly what the manager is doing. How are they constructing the portfolio? How often do they rebalance? So there's a lot of quantitative analysis, but we also focus on people and investment philosophy. We only hire managers who share our investment philosophy, that have good governance procedures in place, that have great business continuity plans in place. We tend to shy away from firms that are very personality dependent.
Hmm.
Firms where there's a hero or a guru who tends to dominate all of the decision making. We definitely shy away from those types of organizations in public markets. Private markets is a different conversation. Unlike public markets, in private markets, manager selection is absolutely critical. If you and I were to go into the Morningstar database right now and look at all of the US large cap value managers in Morningstar, we're going to find that there's a very tiny dispersion among them. They're all owning the same stocks, right?
Hmm.
So you're not going to see a big difference between the top and the bottom within US public markets. In private
Right.
markets, that spread is massive, absolutely massive. It's off the charts. So manager selection is absolutely critical. When we are evaluating for example, a private equity GP is the equivalent to the fund manager in
Hmm.
private equity. We look at every single prior vintage fund that they've ever offered. We look at their returns. We want to make sure that they're top quartile relative to their pre-Quin peer group. We then go in and look at every single portfolio company that they have ever invested in within each fund vintage that they have ever managed. And we disaggregate where the returns came from to understand how much of the return came from multiple expansion. So that would be, for example, cheap leverage. How much of it came from EBITDA growth,
Hmm.
improvements in profitability? How much of it came from revenue growth? What we're really trying to understand there, David, is to what extent did the GP, the fund manager,
Yeah.
actually create value, or did they just ride the wave? That's what we
Right.
want to know.
Right. They just take advantage of, the interest rate environment to juice some returns versus did they actually come in and provide some, a growth strategy that or whatever or a turnaround strategy or whatever they did they actually manage something
Exactly.
and provide some real return in what they were doing.
It's analogous to beta in public markets, right? If you have an active manager that you're paying 80 basis points to, and all they did was give you the same exposure as the S&P 500 index,
Hmm.
well, you could have bought that for virtually zero, right? So
Right.
we're doing the same thing in private markets, is understanding where's the value creation really coming from.
And is it difficult to do that because they're private, or you are able to really? I mean, that sounds like a lot of work that you're doing in terms of like drilling into their history. Is that hard to access that information, or is it something that you just get through their filings and talking with them and looking at the underlying companies they've purchased?
Well, there are no filings, right? These are
Right.
private markets. So yeah, what I would say is yes, it is difficult. Getting the information, getting access to what we call the GP's data room is fairly simple, fairly straightforward. Most GPs who are worth investing in are very forthcoming, very transparent. They want to give you their information. So getting the information is easy. Having the appropriate training and expertise to know how to interpret the information, how to analyze the information, that is much harder. You really do need to have advanced training in financial accounting. Uh, Everyone on our team, they're either CFAs or MBAs. I mean, they have lots of training in these sorts of things, and so being able to digest that information, interpret that information, and then draw conclusions from that information. That I think is what makes private equity, venture capital, especially those two asset classes, certainly less accessible to many advisory firms. We actually have an entire team of dedicated private markets analysts who've actually been doing this for about 25 years, and that's all they do
Hmm.
is due diligence on private fund managers and different private asset classes. And so that is a very seasoned, very experienced group of investors that have lots of experience digesting and analyzing that type of information. So getting the information is easy. Understanding and interpreting that information is certainly a lot harder.
Well, Don, I could probably just keep shooting questions at you all day, but we've been talking for a pretty good stretch here. So I think probably should try to wrap this up. But I guess if there are you know any last words or any big themes that I didn't ask you about that you think would be good just to leave the audience with.
I think one theme that I'd probably leave the audience with is that technology will continue to revolutionize and democratize our business. And I would say that generally that is a good thing. However, it is not always a good thing. And I think the role of great advisors is to really understand how these innovations either help or hurt our clients. And I really think that over the next 3 to 5 years, what you're going to see is more and more technology will effectively disintermediate a lot of asset managers. And so what you're going to see is RIAs start to insource more and more of the asset management experience, that entire process. And what I think that means is that RIAs especially are going to have to learn how to do due diligence, not just on asset managers, which is something we've been doing for many decades, but understanding how to do due diligence on those types of technologies that we may be considering bringing in-house to use to manage our clients' assets that will effectively disintermediate asset managers. And so those would be the parting words that I would leave with our audience.
That's definitely something to chew on. Well, Don, I appreciate you taking the time, sharing your insights, rolling with my questions, and the way that sometimes I pop around to different themes. So I appreciate you kind of just rolling with me.
Of course, it was fun. Thank you, David.
So, David, how can people get in touch with you if they have some questions?
Best way to find us is obviously at wealthmanagement.com. All of my content is in the investment section of the website. That's where you can find this podcast as well as our any daily or weekly reporting we're doing on investment trends. In addition, LinkedIn is a good place to reach out to me.
All right. Thanks to both of you. And thanks for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.